Beginner's Guide to Day Trading. Day trading is an exciting yet challenging form of trading where individuals buy and sell financial instruments within a single trading day. Unlike long-term investing, day traders capitalize on short-term market fluctuations to generate profits. While it offers significant opportunities, it also comes with high risks. For beginners, understanding key principles, strategies, and risk management techniques is crucial for success. Before we get started, subscribe to our channel and turn on the notification bell so you never miss our latest content. Understanding the basics of day trading. Day trading involves buying and selling stocks, forex, or other assets within a single trading session. The goal is to profit from short-term price movements, often within minutes or hours. Unlike investing, where profits come from long-term market growth, day traders rely on quick decisions, technical analysis, and market trends. It requires access to a trading platform, a brokerage account, and a thorough understanding of market mechanics. Beginners should start by familiarizing themselves with common trading terms, such as bid-ask spread, volume, liquidity, and volatility. Trading requires discipline, a clear strategy, and an understanding of order types like market orders, limit orders, and stop-loss orders. Additionally, traders must stay informed about economic events, earnings reports, and other factors influencing asset prices. Proper education and preparation can significantly improve a trader's chances of success. Choosing the right brokerage and platform. Selecting the right brokerage and trading platform is essential for day trading success. Brokers provide access to markets, order execution, and essential trading tools. Beginners should consider factors such as commission fees, platform usability, real-time data access, and order execution speed. Low commissions are crucial, as frequent trades can accumulate costs. Many brokers offer demo accounts, allowing traders to practice without financial risk. Additionally, the platform should provide advanced charting tools, indicators, and fast execution capabilities. Some platforms cater specifically to stocks, forex, or cryptocurrencies, so choosing the one that aligns with trading preferences is key. Security and customer support are also important, as technical issues can impact trading performance. Evaluating different brokerages based on regulation, reliability, and available features will help beginners make an informed decision, ensuring a seamless and efficient trading experience. Developing a trading strategy. A solid trading strategy is the foundation of successful day trading. Strategies vary based on risk tolerance, market conditions, and asset types. Common approaches include momentum trading, where traders buy assets experiencing strong upward movement, and scalping, which involves making multiple small trades for quick profits. Other strategies include breakout trading, where traders enter positions when prices break key support or resistance levels, and mean reversion, which capitalizes on price corrections. Backtesting strategies using historical data can help determine their effectiveness. A good strategy includes clear entry and exit rules, stop-loss placements, and profit-taking criteria. Beginners should start with a simple strategy, refine it through practice, and avoid overcomplicating their approach. Emotional discipline is crucial, as impulsive decisions can lead to significant losses. Constant evaluation and adaptation to market conditions are necessary for long-term trading success. Risk management and capital preservation. Effective risk management is vital for protecting trading capital. Without proper risk control, even the most profitable strategies can fail. Beginners should never risk more than 1 to 2% of their trading capital on a single trade. Using stop-loss orders helps limit potential losses, while take-profit orders ensure gains are secured. Diversification across multiple trades and assets can reduce exposure to a single market movement. Understanding position sizing is also critical. Traders should allocate funds based on risk tolerance and strategy requirements. Leverage, while offering the potential for higher profits, also increases risk, making it essential to use it cautiously. Avoiding emotional trading, sticking to predefined risk parameters, and continuously reviewing performance are key aspects of risk management. By focusing on capital preservation, traders increase their chances of long-term profitability. Technical analysis and chart patterns. Technical analysis is a crucial skill for day traders, as it helps identify potential entry and exit points. It involves studying price charts, indicators, and patterns to predict future movements. Common indicators include moving averages, RSI, relative strength index, MACD, moving average convergence divergence, and Bollinger Bands. Chart patterns like head and shoulders, double tops, and flags provide insights into market trends. Support and resistance levels help traders determine potential reversal points. Candlestick patterns such as doji and engulfing provide valuable insights into market sentiment. Learning to analyze charts effectively requires practice and experience. Beginners should focus on mastering a few reliable indicators before exploring more complex techniques. Combining multiple technical tools can increase the probability of successful trades. Technical analysis is not foolproof, but serves as a valuable tool when combined with sound trading strategies and risk management. Understanding market psychology and sentiment. Market psychology plays a significant role in price movements. Fear, greed, and herd behavior influence market trends, often causing irrational price swings. Traders must understand how sentiment affects market dynamics. For instance, high optimism can lead to bubbles, while panic selling can create undervalued opportunities. Monitoring news, earnings reports, and macroeconomic events helps gauge market sentiment. Volume analysis and sentiment indicators, like the VX Volatility Index, provide additional insights. Avoiding emotional decision-making is critical. Traders should stick to their strategies and remain objective. Understanding crowd psychology helps traders anticipate potential reversals and breakout opportunities. Developing a disciplined mindset, staying patient, and managing stress are essential for long-term success in day trading. Recognizing emotional biases and staying rational can significantly improve decision-making and trading outcomes. Day trading is a rewarding yet challenging venture requiring knowledge, discipline, and strategy. Beginners must start with a solid foundation, including technical analysis, risk management, and market psychology. Choosing the right broker, developing a trading plan, and continuously learning are key to success. While risks are high, a disciplined approach and well-planned strategies can lead to profitable opportunities. By mastering the essentials, beginners can build a sustainable and successful day trading career. If you enjoyed this video, give it a thumbs up and subscribe for more content. Hit the notification bell to stay updated with our latest videos. Share your thoughts in the comments below. Thank you for watching.